I welcome you all for the webinar on GST series for real estate. Today's topic is reversal of ITC under Rule 42. I am honored to welcome our speakers for the day, CA Venugopal sir, CA Rajesh sir, CA Ashika madam. Let me start by introducing our first speaker for the day, CA Venugopal sir. He is a founder partner in Venu and Vinay Chartered Accountants since 2002 with academic credentials, which include securing All India 45th rank in CA final. He is also certified information system auditor. He has completed various other certification courses from ICAI, namely DISM, course on business valuation, course on internal audit, course on fraud detection, and forensic accounting. He has completed a one-year course from IIM on data analysis and business intelligence. He has authored various industry-specific handbook on GST. He has contributed to the technical guide on GST audit released by ICI and other publication materials. He has developed a lot of Excel-based free utilities on GST like JSON Reader, creating JSON files, GST Invalidator, composition versus regular benefit analysis, GST Impact Reader, real estate project switch decision analysis, GST audit working paper tool, and many more. He is a GST faculty for ICI and conducted various workshops and webinars. Apart from audit, he has hands-on coding in Visual Basics, .NET, Python. He also reviews database design. He conducted various workshops for corporates on use of technology, improve efficiency at work using Excel, building automated reports from accounting and financial applications. He is a man behind the development and managing of cloud applications like Tax Miles, Insta Financials, and many more. Now, it's the time to introduce our second speaker for the day, CA Rajesh sir, who is one of the top chartered accounts in practice and partner at Venu and Vinay, chartered accounts and proprietor of RKTR and Co. He is practicing in the field of indirect taxes at Bengaluru for more than 20 years and advising the clients on compliances, tax planning, and representation to the government and authorities. He has authored number of books on GST, Central Excise, Service Tax, KVAT. He has author, joint author, as well as assisting author. To name some of the books, handbooks on annual returns and GST audit, GST reckoner, GST tariff, practical guide to the service tax, Central Excise made simple, Central Excise law and procedures, and KVAT audit manual. He has also contributed for background material on GST and UAE VAT published by ICAI. He has been training the professional students, industry, and departmental authorities in the field of indirect taxes and invitations from ICAI, ICSI, NACIN, Tax Department of State and Central, educational institutions, trade bodies, professional bodies, and many more. He has written many articles on central excise, service tax, VAT, and GST for various professional journals. Now I am honored to introduce our third speaker for the day, C. Ashika Madam. She is a current holding the position of Senior Manager GST at Venu and Vinay Chartered Accounts. Having an achieved chartered accountancy in 2013, she has dedicated her professional journey to interact claim of indirect taxation. She has comprehensive exposure to the GST ranging from examination of taxability, compliances verification, educations, and appeal and representation at all levels. In addition, she has been active participant, actively contributing her insight to the various discussion and topics surrounding GST. Today, from these experts, let us learn more about commercial unsold units, mixed project treatment of post-OC expenses. I request Venu sir to take over from here. Over to you, sir.
Thank you, Vishwas.
Thank you, sir.
Let me share my screen. All right. So the screen is visible, right?
Yes, sir.
So, welcome all, and thank you, Vishwas and Reda Consultants LLP for continuously doing the knowledge update series on the GST, and special thanks to the Naredco, Karnataka, and Okaza. Let's move on to today's discussion, which is ITC reversal. All right. What we are going to understand is Rule 42 of the real estate industry. And specifically, we know real estate industry do not have any input tax credit. But however, how does the input tax credit that would be applicable to them, or what is the common credit reversal, is what we are going to discuss. I'm going to cover various aspects. Depending on the time, we will look at it. But main focus on today is how to compute common credit, how to reverse the credit, and project-wise, and use of mixed projects, meaning commercial and residential. This is what we are going to do. As usual, every slide, every session, I make it a point that everyone who is into real estate industry, practicing or connected to GST in real estate should be aware of this notification. Notification 3/2019, which made changes into the rates. 4 gave exemption for the TDR, and subject to a liability to be paid by the builder, which has been defined in notification 5, where the TDR computation has been given for the builder. And equivalent to 4/2018, release issued on 25th January 2018. The time of supply deferred for the liability on construction services and TDR is equivalent 6/2019. 9(4) applicable only for real estate industry. So rate for services is given in 7, and capital goods is given in 8. There are other procedural change, which is we are discussing today, is on the rules, which is Rule 42 and 43 that got changed in 16/2019. So our today's discussion is from the notification 16/2019. Which is common credit reversal, Rule 42 and 43. First, let's understand the Rule 42 reversal computation. We all know this is applicable from 1st April 2019. So the projects which got completed till 31st March 2019, so the reversal is applicable basis the old Rule 42. The old Rule 42 had only one formula, which we are going to see now. The projects which completed after 31st March 2019, it could be something who would have started after 19, or something started prior but completed after 19. There is something a transition credit. So people opting to a new regime, which is 5% without ITC, or old regime continuing to be under with ITC. So the Rule 42 per se, when they have drafted, they have taken into cognizance of all these likely changes that are going to come. And the Rule 42 starts with that rule which is applicable to everyone. All right. Now, Rule 42, then they brought in the entry notification 3, 4, 5, 6, where if it is someone who is an ongoing project, which is commencing, or something which is commencing on or after 1st April 2019, which did not undergo or required transition of input tax credit. So old projects which did not undergo transition is subjected one method of definition. Then we had the computation for those which have undergone the transition. I'll give you an example of how this happens in the slides coming in. But main discussion is after it is transited, how does it fare out? Now, this is the view of various components of an input tax credit. The input tax credit is broken into various segments: T1, T2, T3. These are specifically ineligible. T1 stands to something which is not for business. T2, which is used for exempt supplies. T3, which is though used for business, taxable business, taxable supplies, but specifically restricted under 17 subsection 5. T4 is something which is exclusively available for business. So 100% eligible to take credit is called T4. However, there would be credits common to T1, T2, T3, T4. These are called as C2, the common credits. Now, the C2 is segregated into D1, D2, and C3. C3 is again a left out credit which is eligible. I've just given another view of understanding. If I have to say total ITC as T, what is ineligible credit is T1, T2, and T3. The eligible credit is C1. The eligible credit is C1. C1 has both the T4 and the C2. T4 is 100% eligible and C2 is proportionally eligible or ineligible. Let's look at it again in a pictorial way. If I have to say the input tax credit, yeah. So when we say the input tax credit, this portion is fully ineligible and T4 is fully eligible. So if C2 is a common credit, if something which is common to this is the C2, then again C2 has to be bifurcated into two pieces. So a piece pertaining to this would be ineligible, a piece pertaining to this would be eligible. So that is where in an easy way one can understand. So the common credit reversal is what we are going to look at it today. So the C2, which is common credit in a normal parallel sense. How about real estate industry? In real estate industry, the notification has been issued saying that the T4 will be 0 for real estate. There is nothing called 100% eligible, even though you are doing a fully commercial project. Fully commercial project also has to undergo this method. The entire credits which they have is common credit. So the common credit has to be disallowed if exempted by total or 5% which is D2. What is eligible is left out, which is C3. Let's understand little more. Okay, I'll come back to the case study. So the ITC with respect to a residential real estate project is 100% not eligible. When we say a residential real estate project, we are talking about affordable housing, other than affordable housing, but a residential housing. Or you can see a small note on the right side. If the carpet area of the commercial portion is less than or equal to 15%, then commercial portion would also be treated as residential. So the commercial rate of tax for the commercial would also be at 5%. So the tax rate is at 5% without ITC. So that is why we call it as RREP projects. In an RREP project, 100% ITC is not eligible. All REP projects, which is a real estate projects, could be fully commercial or could be commercial plus residential at a different, maybe 60% commercial, 40% residential, or 80% residential, 20% commercial, 100% commercial. In all the cases, you have to compute the input tax credit reversal basis Rule 42. Let's understand the Rule 42 for the real estate sector. So the T1, T2, T3 is going to be common. It's going to be remaining same. Only the T4 is equal to 0. So for construction industry, both input and input services will be used both for commercial, residential, or commercial sold, unsold. Hence, that has been made as 0. That means the entire credit, if you have to look back here, the entire credit has to be segregated in the following way. So let's say my GSTR 2B, I am into a commercial project. GSTR 2B has 100 rupees. Now, that 100 has to be first segregated into, let's say, 20, which is pertaining to ineligible credits. Let's say pertaining to ineligible credits. What are ineligible credit? Let's say that to be included a motor vehicle, to be included employee staff welfare on tea, coffee, food, and also the insurance. All that has been put aside. Rest 80. Now this 80 has to be seen. You have to see how much is towards commercial and residential. How much is towards commercial and residential has to be seen. So this 80 will not be treated as T4, it will be treated as C2. Now, in C2, what is eligible is only C3. What is eligible is C3. That means we have to find out what is eligible. We have to find out what is ineligible. So the ineligible is computed as D1, which is ineligible, exempted turnover divided by total turnover. Exempted turnover divided by total turnover multiplied by the common credit is ineligible in case of a common credit reversal. The same goes with the real estate industry. So let's now look at it in case of the real estate industry. What is the definition of this exempt divided by total? When we say exempt, it is aggregate area of the apartments which is exempt from tax plus the carpet area of apartments which is not exempt from tax but are identified by promoters to be sold after issuance of the occupancy certificate. So those which are exempt and those which are not exempt but which are getting sold after issuance of occupancy certificate. Now that means what are we trying to say? We are now segregating. We know of the total project, residential is exempt, commercial is taxable. But commercial also is now segregated as sold before OC, something which is sold before OC and something which is sold after OC. So my numerator, my exempted to be computed. What is my exempted numerator? My numerator is this is which is exempted, this A, and even something which is sold after OC, even this is exempted. So the carpet area of these two has to be treated as my exempted carpet area. And F, which is the denominator, is the total carpet area, which is residential plus commercial after or before the OC. Just look at this. Let me know if you have any questions at this point. Please put your questions in the chat. We'll look at the questions one by one and address that. It's audible. Okay. All right. All right. Let's understand the formula. One moment, I am unable to. Yeah. Yeah. So the D1 is equal to carpet area of exempt divided by carpet area of the project. Now this has to be done month over month. This computation has to be done on a monthly basis and you will be recomputing at the end of the project. You will be recomputing at the end of the project. Let me take you through an Excel. Let me take you through an Excel. Let's take hypothetically project commercial has a carpet area of 70,000 SFT. Residential has a carpet area of 30,000 SFT. Right? Now, sold before OC, sold unsold on OC. All right. So let's take, I have sold 80% before OC and some portion is all right. So let us say this project has begun month. It has started on 1st January 2020 and OC has been obtained on, let's say, 31 March 2022. So on 31st March, the OC has obtained. Now, how do we compute the common a credit reversal? This is the question. Let us put a chart out that my ITC accruals month over month. Let us put that. So Jan 20. Okay, hope the Excel screen is visible. Maybe if you want me to zoom it, I can zoom it a bit. Let's just take randomly some credit, okay? Now, each year over year, we have a total ITC of the first year, Jan to March, we have a total credit of 14 lakh 56,000. We have 59 lakh 60,000 and you have 77 lakhs 33,000, the total credit, all right? Now, how do we compute the common credit reversal for this? If this is what is being accrued, in the month of Jan, how much is the credit I need to reverse is the question. So 7 lakh 33 is available in my GST or 2B. And how much I need to take? So let us look at ITC reversal computation. So can anyone tell me how much is the ITC I need to reverse in these respective months? Let's start with Jan. Is there anyone has any view as to what should be my numerator and denominator for the computation of, if you see the screen, the carpet area of exempt divided by carpet area of the project into the common ITC. This is what is the formula. So how much do we need to reverse in the month of January? Anyone has any answer? Can you put it in the chat? All right. So first, let's look at what is my exempt carpet area. My whole of residential, which is sold before OC, sold unsold on OC, is exempt. Commercial unsold on OC is also exempt. But do I know on the date of Jan how much I will be able to sell or unsold carpet area? The answer is no. Hence, the way you will be looking at, let me just. So this is, I will call this as total carpet area. This is exempted carpet area. This is unsold commercial. So the reversal will be the total input tax credit. I am making a presumption that T1, T2, T3 is nil. The input tax credit attributable for the project multiplied by your exempted carpet area divided by total carpet area. Now, out of 14 lakhs, yeah. So out of 14 lakhs, I have a reversal of 3,16,000 in the month one. So you can see, let me just put the formula for you. Just given the, let me zoom the formula. So the formula I am giving is the common credit, which is your C2. So the formula for your D1 computation, the formula for D1 computation is C2 multiplied by exempt carpet area by total carpet area. So I am computing my C2 is a common credit. Everything is common credit. When it comes to your next year, the formula is same. You apply the same, and this goes with the last year. At the end of the project, uh, oh, sorry, I think this was referring to L, should be J. Yeah. So at the end of the project, the only change you will do is this exempted carpet area would also include the exempted carpet area would also include your unsold commercial on the date of OC. So the total reversal that you will be doing for the project, the total reversal for the project. So the credit that is eligible or available to you is 77, 14 and 59 lakhs. But out of 1 crore, you will have to reverse 45 lakhs. You will have to reverse 45 lakhs, which is 23, 17 and 4 lakh 36. So what you are eligible for is this. Now, in other way, which you are computing, what you are eligible for is 56,000 Oh, okay. I think there was a small error in the total thing. This total is no. So out of 1 crore 50, 46 lakhs is ineligible. So if you look at it, your total ITC is 1 crore 50 lakhs, 6 lakhs, and ineligible ITC, which has been derived, is 46 lakhs. Your eligible ITC is 150, 146 minus 50 is your total credit you will be able to take. Let's look at if okay is something, are we missing anything on this? Is something we will have to see. How do I cross verify whether my computation is correct or not correct? The way you will be looking at is at the end of the project, you will have to recompute. At the end of the project, you have to recompute. That is where the unsold one, what we have to do is end of the project, we have to do a recomputation of unsold carpet area, because we have taken the unsold carpet area as in the first months only to pertaining to the residential. But when the project got over, my unsold carpet area attributable to commercial is not considered. So what we have done is a monthly reversal. We have to do out of this, the unsold portion of this has not been taken. So the law says you have to do a recomputation. Well, let us actually put it in a way, reverse ITC. I'll put it as availed ITC. This is what I have availed. Now, let us do a recomputation of eligible ITC or ITC to reverse. Now, ITC to reverse, what is the ITC that I have to reverse? My total carpet area into, sorry, multiplied by exempted portion plus unsold portion divided by total carpet area. What I have to reverse is 66, but what I have reversed is 45. So on OC date, on the date of OC, I have to do an additional reversal. Additional reversal, I have to do 21 lakhs on OC date. In a way, let's say, if we have to understand that ITC is still there, ITC is still there. So you have to do an additional reversal of 21 lakhs. So what means net accrued ITC would be 105 minus 21. That means 84 lakh 53,000 is what will be accrued to me. Mathematical computation of this. Another way, in a simple way, which we have to tell, if my total ITC is 1 crore 50 lakhs, what I am eligible is 56%. What I am eligible for is 56%. So let's compute the value of the eligibility, which is 56%. This multiplied by this, you can see even the both would yield to the same thing. Is this clear to you all? Is the explanation clear? Have you understood how it has to be done or what is expected to be done? Let's look at any questions if people have in the chat. Yeah, so the formulas were wrong. I could see the people suggested changing the total. We did that. Let's move back to our presentation. So what does the presentation say? that you reverse the computation on the month-on-month basis. End of the project, you have to recompute the common eligible credit. The C3, that is what you are taking, you are eligible for. The eligible common credit has to be recomputed every time at the end of the project. That is where the common credit has to be, entire credit has to be treated as common. So that has been given by removal of difficulty orders. I'll come back to the case studies 2 and 3 little later. Recomputation at the end of the project. We've seen this. Now let's go to quickly rule 43. Little complicated than rule 42, but I would suggest better not avail any credits because rule 42 itself is a little complicated to understand. In 43, the challenge comes is anything firstly exempt non-business, it is not eligible. Anything used for taxable and zero rated, it is fully eligible. But for construction services, this will be treated as zero. So everything, entire capital credit has to be treated as the common credit. Now, it is quite common that every project requires some machinery, and no real estate industry will procure machinery separately for residential and separately for commercial. That means the machinery is used commonly. So when a machinery is used commonly, the entire input tax credit, which is partly used, I will say it as the total credit that is there. Now, this total credit has to be divided over the life of the asset, which is 5 years under GST, that is TC divided by 60, we call it as TM. Month on month, you got to find out how much of your TM is eligible. Month on month, you have to find out how much TM is eligible. The sigma of TM is TR. Now, you may ask me that why would it change? The answer is you have multiple machineries. Each machinery is split into 60 months. So each machinery in different block or different month will get lapsed. So the TR will majority of the time will be the same, but at when a machine gets added, TR will go up. When 5 years gets over, the TM value gets reduced. So it will get changed. The value of TR will change. Now I am here to find out what is the eligible and exempt one. Now what I am ineligible is the exempted goods supplies value is E by F into TR. E we all know carpet area. The exempted turnover divided by total turnover. So exempted carpet area divided by total carpet area. What we are talking here is exempted carpet area by total carpet area. On a monthly basis, this has to be done. For example, if an asset has been purchased in month 1, 23,50,000 with an ITC of 4,23,000, so the value of that is 7,050. So the asset 1, the down screen you can see 7,050 is apportioned every month, like 60 months. Then asset 2, which is purchased in month 2. So if you can see, the value of TR is changing month over month. Now your asset 1 will retire at 60th month. Asset 2 will retire in 61st month. So the value of the TR will also keep changing with the assets that are getting retired. Now this TR, which is derived, has to be applied on the exempted carpet area divided by total carpet area. When we say exempted, again the same formula, aggregate carpet area of the apartments which are exempt, that is residential carpet area, D plus aggregate area of the carpet construction which is not exempt, but are identify the promoter to be sold after issuance of completion certificate. So that means these are unsold as on the date of OC. So these are the one you have to take it as your numerator and divided by the denominator, which is the total carpet area, and reverse it. Now this becomes more complicated when assets are not put to use, when assets are not put to use, you will still apply. Now, this has to be done project by project. The another challenge is this has to be done project by project. So the asset is moving from one project to another project. So you have to take carpet area of that project and this project. It's pretty simple. As I explained, it might be easy to discuss. I am definitely not going to do rule 43 in an Excel because it's going to be much complicated. Like if you see the formula which is coming in the slide, it is going to be more complicated. By the way, not just the reversal of the ITC every month, you also have to do an interest computation at the rate of 18%, because ineligible ITC you have availed at the month one itself. So the ITC, while you are reversing, you will be reversing at the rate of 18% interest also with it. And you have to ensure that there is a sub rule which has been substituted. You will have to do a TC final. TE final has to be done and TC final has to be done. What is TE final and TC final? Again, you are recomputing the aggregate area of the carpet area of the apartments which are exempt and which are likely, which are unsold on the date of OC. So you are going to recompute this at the end of every project. At the end of every project, you have to see how much, because the unsold carpet area of commercial will be known only at the end of the project. So this will create another challenge, that as and when the project is being completed, one has to do the recomputation. All right. Now, some other miscellaneous provisions, though this is relating to the earlier thing, I've been noticing that URD purchases, in the last session, we have discussed about 80-20 rule. There are many people who are not following that 80% of the procurement should be from registered persons, and unregistered purchases, 9(4) is subject to tax, other than cement by end of the financial year, cement in the same month. This is one another aspect one should be very mindful of. And ITC reversal for ongoing projects, which is under the old scheme, So those who are under the old scheme, you are continue to take the input tax credit, because you are going under the old scheme. You have filed your annexure 4, and there might be some projects which took like 5 years, 6 years, the thing. It's like your project got launched only in Jan, let's say Jan or Feb 2019, and you have a lot of procurements lined up. You may find it better to be under the old scheme and be with the 12%. Now, those people who are under the old scheme, this computation mechanism which has been given, Rule 42, is applicable to those projects which are under the old scheme also. And they has to be done as if this is existing from the beginning of the project. Next, this computation has to be done by project. So the total input tax credit which is obtained in the organization should also be accounted for each project. Just to summarize, in case of an ongoing project and who have chosen to 5%, 1%, they have to do a transition credit reversal. We had a separate session of transition credit reversal. So reverse all the transition credit. And those who have continued to old rate with ITC, so do an REP or RREP, you will be applying the Rule 42. Now, something which is partly old and partly new. So then the residential portion is exempt. So you will be reversing within the March. The commercial portion, you will again apply the same Rule 42. How do I represent in GSTR 3B? While filing your GSTR 3B, we have the form got amended with 4B1, 4B2 and 4D1 coming in. Something which you are not availing, has to definitely go into your 4B1. Something which you are not supposed to avail, you will not be reporting in your ITC at all. So now, how does this change? Where is the old provisions to the new provision? With the new form that has come, the credits that you are not availing, you are not wanting to avail, you will be reporting in your 4A5 and 4B1. You will be reporting in your 4A5 and 4B1. So an RRIP project, you will be availing full and reversing. In an RRIP project also, you will be availing full and reversing full. But in an REP project, in an REP project, you will be ensuring that some portion, in an REP project, you will be ensuring there is some portion where you have to reverse at the end. You will do the recomputation for reversal at the end. So people who have the multiple projects, you will have to ensure that the ITC is segregated the core project. So if the portion of the ITC, let's say, and a business unit is doing both RREP and REP simultaneously. So the entire credit pertaining to RREP, let's look at this entire credit pertaining to RREP, you will be availing it in full and you will be reversing it again in full. So the mechanism of reporting got changed. Earlier it was to do 4D2. From 4D2, with the change in the form, the expectation is to match with the 2B. So you will, instead of reporting in 4D2, you will not report anything in 4D2. You will report everything in your 4A5 and reverse everything in 4B1. That is the permanent reversal. But for a REP projects, you will only reverse the portion of Rule 42, the computation of D1 which we have done, which is E divided by F into C2. Only that portion will get reversed in case of an REP project. Now, what happens at the end of the project is you will have a higher reversal of Rule 42 and 43 because the value of the E will go up. The value of the E will go up. So the whole of E has to be reversed at the end of the project. So this month on month, when you are doing a reversal, it's on the screen, it is visible that you have a RREP and REP. Imagine there are multiple projects. In GST or 3B, all this got consolidated. So the values which have been reported in 3B, somewhere you have to also maintain a columnar reporting that like 4A5 of each project one, 4B1 reversal of project one. You also have to have the internal accounting system which will track this reversal which happened so far till the end of the project. It's very important that you establish to the GST officer that this is what I have reversed, but this is pertaining to so and so project. Now that is the very key when it comes to your accounting. So that is what you have to advise in terms of the bookkeeping, that can I segregate, and maybe month on month you should pass your accounting entries. When I reverse, where against which project, maybe the bill reference, cost center, whatever be the methodology, but you need to have a track. It becomes even more challenging that when if someone makes some error, instead of like it's quite common. I see a situation where I have purchase value, CGST, SGST, people just copy that and paste it. So the total purchase value goes into IGST, ITC, CGST, ITC, SGST. Not intentional, but unintentional error happens. When things like that happen, when you are reversing, so you also need to have a track that these are credits availed, not pertaining to any project, credit reversed, not pertaining to any project. So your like how we discussed about Rule 43 reversal, where you have to have a matrix month over month. Even the project GST or 3B, month on month, you need to have a summary level of the 3B project level reconciliation. Friends, these are the various things that you need to be aware of the input tax credit. Currently, both Rajesh and Ashika are in departments, so they couldn't join. I'm sure if they said by the time if it is over, they would join. But I think Rajesh sir is here. Rajesh sir, anything that needs to be added?
I think when your deliberation was quite exhaustive with the calculation and all those things, I only want to just say that this Rule 42 always comes with multiple perspective from the builder's perspective, while computing eligible, ineligible, and computation part of it when it comes up. Sorry. I think, especially when this commercial and non-commercial, there is a residential thing comes, the segregation, bifurcation, and identification. The one is the tactical way of looking at the things and maintaining documents and segregating and taking a separate bills if possible to the extent of the commercial and residential, if possible, can save sometimes rather than going in the formula-based methodology is one of the approach which people can look at. Is only one suggestions I can give. Otherwise, lot of still judicial things is yet to flow in this area. New dimensions is yet to come. We will see, because the industries are the best innovators of ideas for the cases and litigation. When the cases come, notices come, they will come out and teach us with new line of defenses. Why it's not logical? Why I can't do this? Why we can't do this? So all the participants, think how it would impact you, how it impacts your pocket. So once you feel that how it impacts your pocket, then your mind starts working faster and deeper, so that you will come out with ideas and ask Venu and peg him and say that no, sir, I don't agree with you, I don't accept your thing. So like that, you want the idea is not only to give you what our perspective, but we also want you to come out uh, critically against our views and give us comments saying that why this is not possible, why the other angle is not possible. I'll just share one example which happened yesterday. One CA called from other place and said this real estate only. Sir, valuation of landowners area. Sir, I have got 3 multiple floors. I have sold ground floor first to the third party. I am giving in all the floors to the landowner. My second floor rate is much lesser than the ground floor rate. So if I adopt the area given to the landowner, so I will be paying more. So don't I have any idea for it to reduce it? So it was in fact a commercial as well and residential mix-up. Then after due discussion, what suggestion I was just making is, in your arrangement, your documentation, clearly make types of areas, that is commercial type 1, commercial type 2, residential type 1, residential type 2, and each are separate class in itself. And in that respective thing, which is the first cell, try to adopt that, so you will get a better computational rate. So I'm telling, generally the notifications, the rule book may not come out with, but practically when we look at it, we may come across many of these things. And I also told them, this is not merely what we may say, also take a municipal records also, where the valuation rates are fixed differently for different floors, which also substantiates that the stand which you are taking for valuing the thing. Same way I'm telling that what is directly attributable, which what will be constructed ground floor may have a higher cost, deeper cost, that is the foundation cost, whereas others may not. So all these things you can look at and come out while computing rule 42 direct, indirect. There is some possibility of savings. If it something is possible, you can look at it. So only these are my inputs on this aspect. I think over to you, Venu.
Good. Thank you, sir. That's why I always say when persons who are into litigation looks at it with a different perspective, a new thought comes. And friends, I always suggest that when you find there is a difference of opinion, it's always worth fighting for it, because it's another view that you have, and it's ultimately the courts are there to give it. Unless we have a circular which is saying that this is the view, I think till that point, we should take the support of Rajesh sir in fighting any of the cases. All right. So if there are any questions, maybe you can unmute yourself and ask, or if there is anything in the chat, let me pick up from the chat and see. Vishwas is saying where under 5% scheme, we have not availed any ITC. We have received a notice for reversing ITC, how to reverse. Yeah, okay. This is a quite important thing. Now, we all know that we are in a federal system. There is a state government and the central government. The taxes attributable to what we think is whatever I'm paying month over month, CGST, SGST in cash is what going to the government. But the ITC which I am not availing is someone had actually, let's say, someone from Delhi has raised an IGST invoice to me. I am here in Karnataka. Now, this is an it would be sitting in the IGST settlement for the GST in the GSTN, the place of supply is Karnataka. However, it gets settled after the amounts to be paid. Now, for me, it is an ineligible credit. It's an ineligible credit. Now, the moment it is an ineligible credit, whole of that IGST is attributable to the state of Karnataka. It is, they are not availing it. Now, for the Karnataka to claim, again, this, I believe this is the procedure. So that is where they have brought in the new system of 4B1 and 4B2, wherein you report entire 4A5 and ineligible, you report it into 4B1. That is the revenue that would go to the state. I think person whomsoever asked this query, ineligible credits you wouldn't have availed. So the right procedure is to avail all the credits, put it into your 4A5 and report it into 4B1. That is how it has to happen. However, there cannot be a notice on the credit that you have not taken. They cannot levy anything. At max, there can be a general penalty of non-compliance with the right procedure. Any other question? All right. Perfect. It's 5. I think Vishwas, over to you.
Yeah, thank you, sir. Dear participants, thank you for your active participants and special thanks to our speakers for giving us their valuable time and valuable suggestions to us and insights on today's topic. Hope the session was informative and knowledgeable. If you have any queries, please do contact us. Thank you. Have a great evening. Thank you, sir. Thank you.